Your market news now. Stocks wobbled after the latest round of earnings raised concerns amongst investors over the economic outlook. Even Google parent Alphabet disappointed, adding to the angst over painfully high interest rates. Mega-cap tech companies have been a huge success story for equity investors this year. Yet shares in Alphabet fell 6.9% in pre-market trading after it reported another slowdown in its cloud business, while Microsoft shares rose more than 3%. In commodity news, oil prices fell for the third straight session after a flurry of slow economic data from Europe weighed on the outlook for energy demand. To give us some perspective on the markets, we are joined by Chantal Marx, who is the head of investment research at F&B Wealth and Investment. Chantal, thank you so much for your time. I mean, given this picture that I've just described, where we're getting these mixed tech earnings so far, how's the market performing and how are we comparing with our peers?
So the market is performing like we've just received mixed tech earnings, and as if there's a lot of uncertainty out there. I mean, even when you're looking at the JSE today, the market was trading in the red for most of the morning, and now it's just started picking up again, and it's very conflicting as well. So I mean, for example, you'll have FirstRand that is up, but Standard Bank that is down. So no specific direction in the banking industry. Miners are doing a lot better today because commodity prices are higher, but industrial stocks are under pressure. Some of the Rand hedges are under pressure despite the Rand being weaker. So there's a lot happening at the moment, and there's a lot of uncertainty out there and a lot of conflicting messaging, and therefore very mixed markets.
Speaking of a lot happening, we've been talking about bond volatility over the past 3 weeks or so. Have you wrapped your head around what has been causing these increases in yield, whether it's technical or something else going underneath?
So my thinking is that it's rooted in uncertainty, which actually should be quite positive for particularly US bond yields. But I think that the uncertainty around the interest rate trajectory and perhaps the risk being weighted currently towards high interest rates, higher for longer, perhaps another hike on the cards because of the strong US economy is really what is driving the uptick in US bond yields. And that is having a knock-on impact on the rest of the world. And in fact, in emerging markets, it's probably a little bit more pronounced because of all the chaos going on right now. Apart from the fact that we can't really see through inflation and interest rates at the moment, and there's uncertainty around a possible recession in the US, you also have geopolitical factors to contend with.
Outside of that, we are still focusing on US earnings season. What's been priced into earnings, especially from the equity side?
So I think it's very sector specific. I think in certain instances, the market is probably a little bit too bearish. And we've started seeing some reports coming through that really show a much stronger than expected consumer market. And on the flip side, you have very strong expectations coming through from the tech space, and those counters now look a little bit more on the expensive side. So I think overall the market is probably pricing in much higher earnings from next year onward, but I think that there's probably a risk to that depending on how this interest rate regime, the inflation story, and the American economy plays out over the next few months.
Speaking of those big tech earnings, with our analyst yesterday, we were having a conversation about whether there might be a big market punishment for the tech companies that don't deliver, and also that, I suppose, underperform expectations when it comes to the guidance. How are you seeing things given this background, again, of high yields?
So, I mean, we saw that play out overnight in aftermarket trade with Alphabet and Microsoft. Microsoft delivered better than expected results. Everything across the board met expectations or was better than expectations, and the stock has been bid up in post-market trade or in pre-market trade, depending on how you want to define it. Alphabet, on the flip side, actually did beat expectations on revenue and earnings and margins, and they saw advertising a lot stronger than what was expected, but they missed on cloud. So I think that the focus is going to be on kind of the next thematic the next thematics. So be it cloud, be it cybersecurity, be it AI. And if these companies are underperforming in any of those spaces, I think that they are going to be punished, because with big tech, the market is pricing in long-term above average growth. So in the context of higher yields, when that growth disappoints, the fair value, or the expected fair value, anticipated fair value for the stock probably comes under pressure.
We were talking about geopolitical tensions a little bit earlier on. For investors, where do you hide in the short to medium term as all of this plays out?
Well, personally, it feels like a swear word to me to say gold, but I think that a portfolio can benefit from being diversified into something that's completely uncorrelated to the rest of the market, and that does have safe haven appeal. And I mean, US Treasuries, I think, would have been a space that I would have much rather considered than gold. But given where Treasuries are at the moment and the volatility around it, it's probably not acting like a safe haven. That said, I do think that there is a lot of opportunity in this chaos, and US Treasuries would be one of those opportunities.
Before I let you go, 60-40 portfolio structure, does that work in this environment?
I don't think the 60-40 works in any environment, to be honest. I think that it needs to be left in the past. What you have now is that asset managers and portfolio managers are looking at a much wider range of instruments, including infrastructure, including things like gold, on top of bonds and equity, and of course having some cash exposure as well to be able to deploy when the opportunities arise. I think 60-40 is probably a little bit overly conservative in environment that we have right now, but also probably overexposes you to volatility within bonds and equities only. So you would want to be much better diversified than only being in bonds and equities.
Chantal, thank you so much for your time. That is Chantal Marx, who's the head of investment research at F&B Wealth and Investment. That is it from me. But when we look at what is happening on the currency side, we are seeing the rand trading at 19.15, and that Brent crude price, which we have been watching ever since the Middle East tensions flared up, has come down a little bit at around 87.03 per barrel.